I'm fucking bombing on them, set a target on them, I fly. I set a bonfire, tell my story when I'm gonna die. Need my ring.
What is going on, you guys? Today I want to talk to you about my first ever real estate investment. So I did close on a deal on January 31st. It was a condo. I'm just going to keep this video between 3 to 5 minutes, and I will drop a more detailed explanation later. So I'm just going to go over the 4 most important points. So the first point is, where are you going to get the capital? So full disclaimer, I did go in with financial backing from my parents. Their businesses had reached a point where they were quite successful, so conversations started to be had with my father where we discussed taking the revenues out of his business and transferring it to other avenues that would bring more rewards potentially in the long run. So once you have your source of capital and your budget set, the second point is to pick a market. So at first we had picked a student rental market. So I graduated from the University of Waterloo, so I was looking at the city of Waterloo. I was looking at properties close to the university that I graduated from, and the reason being was the budget for the condos in this area were low. They were between 250 to 300K, and also the likelihood of them being rented out was very high because we knew that there was a demand there from students. But over time we had to shift our focus, because after speaking with the mortgage broker, we found out that lenders would be less inclined to give you money if they know it's for a student rental. We ended up also finding out that the appreciation for these properties was lower, and therefore we would have to settle for a B lender. And the difference between an A lender and a B lender is that A lender is a major bank, a B lender is an independent bank, and with the B lender you're more inclined to have a higher interest rate and therefore pay a higher mortgage. So we shifted gears, we brought it back closer to home. We started looking at Toronto and the adjacent cities of Vaughan and Mississauga, and as we looked at the market, we were looking at, my real estate agent had showed me a few open houses with pre-construction properties, and ultimately we decided on condos that were already built, because although the pre-construction required less capital at first, we were more interested in getting a constant stream of income right away. So we decided on primarily Mississauga and Toronto, and condos that were already built and relatively new, maybe within 5 to 10 years at most. So once you have the market set, and once you've looked at the finances in the market, one thing I forgot to talk about, which is probably the most important thing, when you're looking at the market, look at the overall success of that market. Look at the jobs. Look at look at the success of look at the unemployment rate. Look at the overall area. Do your research to ensure that this is an attractive city to live in, and that it's not somewhere that has a bad reputation. Point number 3, once you have a market, it's time to start checking out places. So when you're checking out places, there's a couple factors, well, more than a couple factors that you want to consider. So for example, when you're going to condo units, you want to consider the height and the relative positioning of that unit in the building. So for higher units, you're more likely to have a higher pay rate because the view is better. And also in terms of the view, you want to look at the balcony and make sure that there's no buildings in the future that are going to be built to block the view, to make it harder for you to rent out to tenants in the future. You also want to look at the amenities. So think of it from in the shoes of the tenant. What would they like to see if they're moving in and they're paying what you know that you're trying to charge them? Is it going to include a fitness room, for example, a pool? Is that relevant to the income in that area? Another thing, and this is the most important, I would say, is look at the appreciation of the unit and also the building and compare it to buildings nearby. This is going to be very important because ideally you want to sell it within the next 3 to 5 years, and you want that appreciation to be nice and high so you could flip it and make a good profit. Okay, so point number 4, and I'm going to conclude with the results. So as this is my first time, I'm learning so much as we're going. So we did take an L on the first ever investment, and the reason we took an L was because even though it was a solid rental and we did find a tenant, after the mortgage, property taxes, and maintenance, we are losing cash every month. And this may sound like a huge mistake, and maybe over time I'll look back at it and realize it is, but I did do a lot of calculations. I was very conservative, and based on the appreciation, the anticipated appreciation down the road, even with this sacrifice, the short-term sacrifice for the next few years with out of pockets expenses with cash, the appreciation will be enough that when we flip it, we will still walk away with the profit. And also the fact that the appreciation in the rental rate will be able to charge more later on, which will over time go above our expenses. So that is really what I want to go over today. I know some of it may have been a little vague, but I will go over it in more detail in the future as I kind of figure out the approach I want to take with these videos. You can hit me up on all social networks under BBaccSoon, BBaccSoon. Hit me up. I'm always looking to build. I'm looking to invest. I have a lot of content coming, so I'll catch you later. Be back soon.
God won't fucking save you. All these bitches play you. You thirsty, find to pay you, cause you in muddy waters. God won't fucking save you. All these bitches play you. You thirsty, find to pay you, cause you in muddy waters. I got nothing to say.